This is ShadowQuant Forex Edition, brought to you by AriesLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Tuesday, July 21, 2026, and this is the New York session. Now, let's get into it. With the Fear and Greed Index plummeting to a critical 14 out of 100, we are witnessing a definitive shift into a risk-off regime. The S&P 500 is stuck in a narrow range as traders brace for a geopolitical decision on Iran, while safe haven flows push gold, $4,047.94, and the US dollar to fresh highs. As of 9:28 ET, the market landscape is dominated by dollar strength and safe haven demand. We see Aussie dollar at 0.70054, dollar yen at 162.482, and euro dollar holding at 1.1413. Meanwhile, commodities like gold, $4,047.94, and silver, $57.85, are absorbing the inflows. Let's look at what's driving this move and where the flows are actually going. Turning to the schedule, the immediate horizon is relatively quiet on the U.S. data front, which keeps the focus squarely on geopolitics and central bank expectations. Later this week, on Thursday, July 23, we have weekly jobless claims coming out at 8:30 a.m. ET. Following that, the GDP Now estimates will be updated twice. Monday, July 27, and Tuesday, July 28, both at 7 o'clock a.m. ET. These updates will be crucial for gauging whether the current 3.63% Fed rate is sufficient to contain the 3.46% CPI print without choking off growth entirely.
That's right, and since the data calendar is light, the market is letting the headline risk speak for itself. With the VIX already expanding to 18.77, those GDP Now updates later this week will be the only real metric checking if the soft landing narrative is still intact, or if the fear index staying at 14 is justified.
Let's dig into the headlines shaping this session. First, a major development from Washington regarding North American trade dynamics. Greer stated that Canada is giving other countries better trade deals. Simultaneously, President Trump reportedly rejects a proposal for a 10-day ceasefire with Iran, while U.S. Treasury Secretary Bessent notes that 3% growth is not unreasonable. On the domestic front, the ADP weekly NER pulse dropped to 16,500 versus 19,750 last week, signaling cooling private sector momentum. Yet in Europe, UK jobs beat expectations, and German ZEW surveys show a pickup in recovery mood. The headline that matters most for the macro view is the ADP miss combined with the Iran ceasefire rejection. The 16,500 figure confirms that domestic labor momentum is softening, but because the geopolitical risk is so high, the market is ignoring the soft data. Instead, it's pricing in a higher for longer scenario because the Fed can't cut rates with 3.46% CPI running hot. That's why we're seeing the DXY leveraged funds net long at plus 4,438. They aren't trading on jobs, they're trading on the refusal of the Fed to ease amid geopolitical chaos.
And look at the flip side of that coin, the UK jobs beat. It's the only positive labour signal in a sea of red. That's why pound leveraged funds are net long at plus 28,541, a massive plus 29,099 week-over-week change. While everyone else is dumping euro and yen, smart money is rotating into sterling because the fundamentals there are actually holding up against the global slowdown.
So we have a divergent message. US data is weak, but the dollar is strong because of fear. UK data is strong and the pound is rallying. Let's start with the big picture, the US dollar and gold. First up, let's talk about the US dollar index components and gold. Gold is up plus 0.95% to $4,047.94, sitting just 13.96 pips below its 5-day high of $4,061.25. Meanwhile, dollar pairs like dollar CAD, 1.40789, and dollar yen, 162.482, are pushing against their respective 5-day highs. Grid, what is the technical structure telling us here?
It's telling us we are at a liquidity cliff. For gold, the price action is essentially hugging the ceiling. At $4,047.94, it's testing the 5-day high of $4,061.25 with almost no resistance overhead. That's a classic breakout configuration. But look at dollar yen. It's at 162.482, pressing right into the 162.6 high. And euro dollar, it's at 1.14132, hovering right above its 5-day low of 1.14024. Technically, the entire system is stretched. The floor for the euro is being tested and the ceiling for the yen and gold is being challenged. There is very little room for error here.
And that's where the danger lies. You're calling it a breakout grid, but I'm calling it a trap. The VIX is at 18.77, up plus 2.4. When volatility expands like this, technical levels become meaningless. Look at the COT data. Yen leveraged funds are net short 90,461 contracts. That is an absurdly crowded short. If dollar yen ticks above 162.6, you don't get a clean breakout. You get a violent short squeeze. The breakout grid Cs might just be margin calls forcing buyers into the market. The risk is not a gradual rise. It's a gap up that wipes out stops instantly.
SPECTER is right about the squeeze risk, but he's missing the flow direction. Those 90,461 yen shorts aren't just noise, they represent a structural imbalance. The DXY leveraged funds are net long plus 4,438. The institutional flow is explicitly betting on dollar strength. So while SPECTER warns of a squeeze, the actual money is flowing into the greenback. The question isn't if it moves higher, it's how fast it clears those yen shorts. And speaking of clearing shorts, look at Canadian dollar. Dollar CAD is at 1.40789, nearly touching the 1.40869 high. Why? Because Canadian dollar leveraged funds are net short 92,771. The market is pricing in Canadian trade deal weakness alongside general risk-off sentiment.
But let's contextualize the Canadian dollar move. It's not just about Canadian dollar shorts. It's about the yield curve. The 10-year 2-year spread is flat at plus 0.39 pp. That flat signal means caution. The market knows that even though the DXY is up, the underlying economy isn't screaming strength. That's why the ADP pulse dropped to 16,500. We are seeing strong dollar, weak economy dynamics. The dollar is strong because it's a safe haven, not because it's growing. That distinction drives the gold bid harder than any technical level on dollar yen. So we have a crowded yen short, a flat yield curve, and gold testing highs. Let's pivot to the European complex. Euro dollar is at 1.14132, right above the critical 1.1402 for support. And cable is at 1.34374, showing relative strength. CIPHER, walk me through the positioning divergence here.
The divergence is stark. As I mentioned, yen and euro are getting hammered. Euro leveraged funds are net short 53,691 contracts, with a weekly change of 53,133. That is fire sale positioning. But contrast that with pound. Pound leveraged funds are net long plus 28,541, with a weekly increase of plus 29,099. While the euro is being dumped by speculators, capital is aggressively building long sterling. This isn't random. It's linked to the UK jobs beat. The flow is clearly rotating out of euro-denominated assets and into British ones, even as the broader G10 suffers from risk-off.
And technically, the charts confirm that rotation. Cable is at 1.34374, comfortably above its 5-day low of 1.34125. It's holding firm. Meanwhile, eurodollar has collapsed to the bottom of its 5-day channel at 1.14024. The technical structure for the euro is broken, it's trading at support. For pound, it's consolidating above support. If euro-dollar breaks 1.14024, we're looking at a much wider gap down. But pound is insulated by that unique bullish COT positioning. It's the only major pair in this session that isn't fighting gravity.
I want to challenge that insulation. You're saying pound is safe because of the plus 28,541 long position, but look at the broader risk register. The fear and greed index is 14/100. In a true risk-off event, correlations converge. Everything falls except the dollar and gold eventually. That pound rally is fragile. It's built on a single positive data point, UK jobs in a global melting pot. If the Iran situation escalates further, that safe hedge becomes just another risk asset. The VIX at 18.77 doesn't care about British employment stats. It cares about survival. My concern is that the pound long is a bull trap waiting for the next negative headline to flush retail longs.
SPECTER, you're conflating risk-off with everything sells equally. That's not what we're seeing. The data shows a bifurcation. Dollar is strong, gold is strong, Swiss franc is strong. But pound is strong against the weak currencies. The ECB is hamstrung by geopolitical risk and tight lending standards. We saw Eurozone banks tightening credit further. The Fed, despite the flat curve, has the optionality to hike or hold. The ECB has neither. That policy asymmetry is why the flow is in pound, not euro. The risk isn't that pound falls. It's that it outperforms the rest of the pack precisely because the Eurozone is weakening structurally.
Interesting dynamic. So the euro is weak due to policy paralysis and crowded shorts, while the pound is strong due to labor data and flow rotation. Let's look at the crosses. Aussie yen is at 113.8245 and euro sterling is at 0.849375. How are the carries handling this volatility?
On the crosses, Aussie yen is interesting. It's at 113.8245. Both Aussie and yen are risk sensitive, but yen is being shorted harder. The 5-day range for Aussie yen hasn't been specified in our immediate snapshot, but watching the Aussie dollar price at 0.70054 helps. Aussie is struggling against the dollar. Meanwhile, euro sterling at 0.849375 reflects the euro's weakness against the pound. Technically, euro sterling is grinding lower as the euro tests support. If euro dollar breaks 1.14024, euro sterling will likely accelerate downward. It's a derivative play on euro weakness.
And remember the commodity link. RC is a proxy for risk appetite. With the fear and greed index at 14, Aussie dollar is under pressure. But look at the Kiwi. Kiwi dollar is at 0.58648. Kiwi leveraged funds aren't highlighted in our extreme positioning list, but typically, when yen shorts are 90,461, the Aussie/Kiwi pair gets squeezed. Here, Ordensd is at 1.1945. The spread between the two commodity currencies is compressing. The flow isn't just leaving the EM/risk complex, it's soaring within it. The money is moving from Aussie to, well, nowhere really. It's fleeing to dollar or gold.
Which brings us back to the VIX. The compression in Ordensd is just the calm before the storm. When that 18.77 VIX pushes past 19, as it easily could given the Iran headlines, those carry trades unwind. Aussie yen will drop faster than anyone expects. The 113.8245 level is not a floor, it's a stepping stone down. The crowding in yen shorts makes every pair involving yen extremely dangerous. Don't trust the stability of Aussie yen, trust the margin calls.
Let's synthesize this. We have a clear risk-off regime confirmed by the 14/100 fear and greed and 18.77 VIX. The macro driver is sticky inflation, 3.46% CPI, preventing Fed cuts, which supports the dollar net long position of plus 4,438. Technically, Grid identified that gold is testing $4,061.25, and euro dollar is testing 1.14024. CIPHER highlighted the unique divergence. Euro is being dumped, 53,691 shorts, while pound is being bought, plus 28,541 longs, creating a structural split in the G10. SPECTER correctly warned that the 90,461 yen shorts create a squeeze risk that could invalidate technical levels via volatility spikes. So the takeaway is not a linear dollar rally but a fragmented one. Dollar strength is universal, but pound is finding local support, while euro and yen are facing structural headwinds. The key level to watch is that euro dollar 1.14024 for support. If it breaks, the flow accelerates. If it holds, we chop in a fear-induced range. And for yen, watch the 162.6 level, not for breakout, but for a blowout.
So to summarize, the market is firmly in a risk-off mode. Gold is leading the charge near $4,047.94. The US dollar is strengthening across the board, supported by the Fed's hawkish stance and geopolitical fears. The euro is under severe pressure near 1.14024, while the pound is bucking the trend due to robust labor data and aggressive long positioning. Traders should watch for a breakdown in euro-dollar and a potential volatility spike in dollar-yen as yen shorts get tested. Stay tuned for the weekly jobless claims later this week. This has been ShadowQuant Forex edition. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Forex edition. Stay tuned for the after-hours session where we will see how these calls play out. Until then, trade safe.